Hi guys, welcome to my Setup and Forget Investing series. This is not a financial advice and only for educational and entertainment purposes. Quick recap. Our scheduled investments executed and bought 3.826 shares of SCHG at an average cost of $26.13. As of this week, our portfolio now has 14.444 total shares of SCHG, which is a total value of $377.99. This week was again brutal for stocks, and I'm expecting more volatility on the market. Today, we're going to talk about the reasons for investing early. Investing early is a smart move because it leverages the power of time, allowing your money to work harder for you through the magic of compound interest. Here's a guide to understanding why starting early can be one of the most beneficial financial decisions you make. First is the power of compound interest. Second is that you'll have more time to ride out market volatility. Third is building wealth gradually. Fourth, you'll harness the benefits of risk and time. Time in the market is easier than timing the market. And lastly, the opportunity cost of waiting. Compound interest is often described as interest on interest. When you invest, any returns you earn, whether through dividends, interest, or capital gains are reinvested to generate even more returns. Over time, this process can accelerate the growth of your investments. Imagine you invested a small amount every month. Over 30 to 40 years, not only does your original investment grow, but so does the interest that accumulates on that investment, compounding your earnings significantly. Let's say you made a one-time investment of $1,000 at 10% annual interest. In year 1, you'll gain $100 of interest. In year 2, it will now be $110. Year 3, it will now be at $121. Over time, the interest will keep increasing as well as the value. As you can see in year 10, if you stayed invested, the interest is now at $235. At year 20, it will be $611. And at year 30, it will be $1,744. This is just you having a one-time investment and not having to do anything. Investing early gives you a longer time horizon to recover from short-term market downturns. Stock markets naturally go through cycles of ups and downs. With more time, you have the opportunity to wait out downturns and benefit from market recoveries, reducing the impact of volatility on your long-term investments. Rather than trying to time the market, a long-term strategy of consistent investing helps smooth out the highs and lows. This means that timing the market is easier and more effective than timing the market. The graph shows you a 30-year span of SPY return. SPY is an ETF that tracks the S&P 500 index. As you can see, only 6 out of 30 years in the market is down. The fund has a 10.79% annual average return. Staying invested for the long term is a net positive. Here is a chart that shows different results if we made a one-time investment of $1,000 with dividend reinvestment at different years. If we invested at 2024, our investment grew by 24.89%. If we had invested at 2023, our investment would now be at $1,600. If we had invested at 2022 during bear market, our money would not grow as much but still more than the initial investment. And as you can see, the longer you're invested, the better the results. If we had invested $1,000 at 2015, it would now be at $3,431. At 2005, it would now be at $7,169. At 1995, which is 30 years ago, it would now be at $22,101. These are all historical data and future gains or losses are not guaranteed. Starting early allows you to build wealth gradually over time through consistent contributions. This habit of regularly setting aside money not only helps you accumulate a larger sum, but also cultivates financial discipline, which is the key to long-term success. Consider using automated investments to contribute a set amount each month, week, or even pay period. This set it and forget it approach makes investing easier and keeps you on track. Here is the chart that shows you the difference if we made a one-time investment of $1,000 versus $1,000 per year. $1,000 per year is equivalent to $3 a day. At 2024, the one-time investment will be at $1,273 versus the $2,289. The delta is around $1,000. At 2023, the one-time investment will be $1,603 versus $3,893. The delta is around $1,200. You can see with the trend, the earlier you had invested, the delta is compounded. But if we had invested since 1995, the one-time investment is only at $22,010 versus $192,884. This goes to show that building gradually with the power of compounding or compound interest makes a compelling case. These are all historical data, and future gains or losses are not guaranteed. Younger investors often have a higher risk tolerance. This is because they have more time to recover from potential losses. This allows them to invest in a diversified portfolio that may include stocks, which typically offer higher returns over the long run despite the short-term volatility. The longer time horizon means that even if some investments don't perform well initially, there's a chance to rebound and grow over time. Delaying your investment journey can result in a significant opportunity cost. Money that isn't invested isn't growing. Starting early means you're taking advantage of every day that passes. Even if it's with a small amount, over time, those contributions add up, and so do the gains from compounded returns. Even if you're starting with a modest amount, the sooner you begin, the more time your investments have to grow. As you can see, the chart shows you the different results if we invested at different time frames. If we invested $1,000 annually at 10% return, if we started at age 20, you'll expect it to have $791,000 by age 65. If we started at age 30, it'll be around $299,000. If you started late and started investing at 60 years old, with only 5 years of investing, it will have a value of only $7,700. The trend shows you the longer you wait to invest, the less time you'll have the investment to grow. Investing early is about more than just putting money into the market. It's about harnessing the benefits of time to create lasting wealth. By starting now, even with small amounts, you set the foundation for a more secure financial future. Remember, every day counts, and the key is to start, remain consistent, and let your investments grow over time. I'll be regularly updating this account, and don't forget to please follow, like, share, and subscribe on my investing journey.